2004, our passion at Apel has made us one of the leading financial service providers in Nigeria, expanding our business in a way that captures every aspect of your life. Apel Asset Limited is our flagship company specializing in the trading of securities, including shares and bonds. With our flagship online platform, Apel Alpha, anyone with a mobile phone can easily invest in and own a piece of their favorite company. Over time, our customer base is your partner in achieving financial.
Good morning, ladies and gentlemen. Thank you and welcome to this session. This webinar is themed the 2025 Nigerian Economic Outlook and Investment Opportunities Ahead. My name is Ngozi Maduka, and I will be your moderator today for this very timely and impactful session. This webinar is powered by Apel. Apel offers a broad range of services which cuts across investment banking, stockbroking, securities trading, registrarship, trusteeship, and wealth management. Today's webinar promises to be both insightful and practical as our honored speaker unpacks Nigeria's 2025 economic outlook, focusing on key sectors, policies, trajectories, investment opportunities, whether you're an investor, a professional, or a business leader. This session promises to be actionable and to navigate your year ahead. Some housekeeping rules before we start. Please endeavor to keep all your devices muted. Please use the chat box and the Q&A box for all your ideas and questions as we go ahead. It is my pleasure to introduce our speaker today, Mr. Teslim Shitabe. He is a seasoned economist and a financial journalist, a corporate finance specialist with over 3 decades of experience in investment banking, financial reporting, and capital market operations. Mr. Shitabe holds a bachelor's and master's degree in economics and statistics, as well as a postgraduate certificate in financial journalism. Over his illustrious career, he has been at the forefront of key economic and financial initiatives in Nigeria, such as leading the first Lagos state government 50 billion revenue bond and contributing to pivotal privatization programs, including the equity flotation of the defunct African Petroleum PLC. He is currently the chief economist and managing editor at ProShare Nigeria Limited, where he continues to shape discourse on Nigeria's economic policies and market opportunities. His extensive expertise also extends to strategy and advocacy through his contribution to the Chartered Institute of Bankers and the Nigerian Economic Summit Group. Without further ado, it is my distinct pleasure to welcome to this webinar today, Mr. Teslim Shitabe, to lead us through this discussion. Sir, if you can hear me, please. If you can hear me, sir, can you hear me? The floor is yours, sir. Good morning once again. While we await Mr. Teslim to join us shortly, I'm sure he's having a network issue on his own end, to soon be resolved. I would crave your indulgence to go through his profile again. So, Mr. Teslim Shitabe is a citizen economist, financial journalist, and corporate finance specialist with over 3 decades of experience in investment banking, financial journalism, financial reporting, and capital market operations. Mr. Shitabe holds a bachelor's and master's degree in economics and statistics, as well as a postgraduate degree in financial journalism. Over his illustrious career, he has been at the forefront of key economic and financial initiatives in Nigeria, such as leading the first Lagos state government 50 billion revenue bond, and contributing to pivotal privatization programs, including the equity flotation to the defunct African Petroleum PLC. He is currently the chief economist and managing editor at ProShare Nigeria Limited, where he continues to shape discourse on Nigeria's economic policies and market strategies. His extensive expertise also extends to strategy and advocacy through his contributions to the Chartered Institute of Bankers of Nigeria and the Nigerian Economic Summit.
Hello, good morning.
Without further ado,
can you hear me?
I would like to welcome Mr. Teslim once again to this webinar.
Hello,
It is
good
my
morning. Can you hear me?
pleasure to have you on this webinar with us once again. Mr. Teslim,
should I go ahead with my presentation?
Okay. Pleasure to have you here with us again, sir. Please, the floor is yours.
Okay, can you hear me now?
Yes, I can hear you, Mr. Teslim.
Good morning, ladies and gentlemen.
Welcome to the webinar, sir.
We apologize. Okay, good morning, ladies and gentlemen. We apologize for the technical hiccups. I can assure you that doesn't reflect the outlook of the Nigerian economy in 2025. Ladies and gentlemen, it's a great pleasure to be here having this conversation this morning. It's timely. It's the first month of the year. And it's also at that period where we're all anxious to see what the National Bureau of Statistics will come up with concerning the rebasing of the Nigerian GDP, as well as the rebasing of the Nigerian Consumer Price Index, CPI, which is also a measure of inflation. Both figures becoming critical in taking decisions in the course of the year. But before we get to that point, which we will definitely discuss in extensive detail later in the presentation, I would like to say that this is a conversation that will be as much as possible straight to the point, and it will try as much as possible also to address some of the fears, concerns, and emerging opportunities that we have seen in the Nigerian economy. Now, I'm going to try to do three things in this presentation. I'm going to look at the global and African economic markets and see how they're evolving in 2025 and the benefits or the weaknesses of these markets and how Nigerian investors should respond. The second thing I want to take a look at is the Nigerian economy and its various subsectors. One of the things we've done at my organization is to look at the 46 sectors in which the Nigerian GDP is categorized, and we have compressed them into 14 sub-economies. And as we go on in this conversation, we will see how these 14 sub-economies lead to what my organization calls the hexagon of economic power in Nigeria. Hopefully, this will introduce us into a whole of government approach to resolving some of the contradictions, conflicts, and perhaps leading us to the opportunities that exist in the Nigerian economy that we see in the course of the year. Now, finally, we will take an outlook on investment opportunities within an environment of rebasing. Rebasing is going to be a pivotal issue in the first quarter of 2025, and therefore we have made it an issue that we feel is topical and needs to be addressed by investors and other stakeholders in the Nigerian project. Now, let's start out. Let's go to basics first. The global economy. The global economy grew, it's estimated that it grew at 3.3% in 2024. Our outlook is that the global economy will slow down in 2025 as a result of a number of issues that relate to economic fragmentation, as well as political dislocations that will occur. I'm sure that everybody is aware of the election in the United States of America and the subsequent election of President Donald Trump, and the policy, the far-right policies that America currently has chosen to adopt concerning trade partners and broader economic relationships. Now, because of some of these policies, we see the global economy shrinking slightly in 2025. So rather than growing at 3.3% that we saw in 2024, we believe that there will be a 10 basis points reduction. So the global economy will grow at 3.2%. Another thing that we feel is that global inflation will moderate, but not evenly across the world. We'll see some moderation in certain economies in Europe and perhaps see a reverse of that in the United States of America, basically because of the tariff policies that America has said it will introduce in the course of the year. If we are to believe information currently available, there may be up to 25% tariff imposition on goods coming in from Canada, and perhaps another 10% on goods coming in from China, or even higher, depending on the good in question. If it's technology-related good, it could go as high as 50% on Chinese commodity imports into the United States of America. So broadly speaking, the outlook for the world in 2025 is rather mixed. The Director General of the World Trade Organization, Dr. Ngozi Okonjo-Iweala, has urged us not to panic. And we actually agree with her. We're not at panic stations yet. Nevertheless, we do need to be vigilant. One of the things that we have said for 2025 is that while we may plan within an environment of order, we must prepare for an environment of chaos. There will be several disruptions in the year 2025 for which we have to prepare for.
Sorry, Mr. Teslim, sorry to interrupt you. Please, we need you to share your slides.
Okay.
Thank you. We can hear you now. Sorry, we can see slide now.
Can't unmute. Yes, right. So thank you very much. Right. So I hope everybody can see my slides. Okay. Right. So one of the major trends we're going to see in 2025 is mixed outcomes for global equity markets. And I know that Apel, companies like Apel, for instance, have interest in global equity transactions. So in 2025, there will certainly be some mixed outcomes in the equity markets. We see, for instance, that the Dow Jones Index will show some positive signs in the course of the year. So that's a market that investors may want to take a look at. We also see the S&P 500. Our calculations suggest that the Dow Jones will be up by 12.96%. The S&P 500, 23.84%. And NASDAQ, 29.81%. Now, when we're talking about the NASDAQ, the particular thing that is of interest is where will technology stocks move to in the course of the year. We recently saw what has happened with DeepSeek, and the outcomes of DeepSeek on the share prices of NVIDIA. Now, NVIDIA is actually recovering, but there's going to be a lot of disruptions, like I said earlier, in the market. So it's good for investors to take a look at NASDAQ and keep an eye on that market, because we see things like what we call agentic artificial intelligence, or agentic AI, having a greater role to play in financial markets in 2025. Now, just a bit on agentic AI. What agentic AI basically means is that AI becomes an agent of those who use it, and therefore it can perform multiple tasks as a result of certain programmings, algorithms that it adopts for the purposes of decision making. And that's going to be a major game changer in technology and in financial markets as we go through 2025. So we might need to, investors might do well to take a look at NASDAQ and monitor NASDAQ carefully in the course of the year. Now, the European markets will be a bit mixed. And one of the reasons is that we're going to see differential growth in the various European markets. For instance, France is having its fiscal problems, and that seems to have some impact on the equity market, the French equity market, the CAC, for instance, might not grow as fast as we would say the market in Germany would grow. As well as the markets in the UK, we see the FTSE growing by about 8.98%, not really roaring, but sufficiently decent returns that those who are interested in European stocks can use to balance their portfolios in the course of the year. The DAX will grow at a very interesting rate. We think that the DAX will grow double digits. To grow to, you could get a yield of about 18.85% in the DAX. Eastern markets will also seem to suggest some significant strength. We think that the Chinese CSI market is likely to do 16.55% in the course of the year. The Nikkei 226 is also likely to do quite well. As a matter of fact, we see an over 50% growth in the Nikkei index. So it's a bit of a hodgepodge of outcomes that we see for equity markets across the globe in 2025. And as I said, that is as a result of major political trends that are occurring. And let's also address, maybe briefly address these trends. In the United States of America, we're seeing a government that is committed to bilateralism. What that means simply is that the government of President Trump would prefer to have bilateral negotiations with countries on a case-by-case basis. So they will defer to negotiating with Canada separately, Mexico separately, perhaps a few African countries separately, and then taking policies from there, rather than having a more inclusive or block interaction. So based on that arrangement, we'll likely see the US becoming less influential in international financial markets. It'll be more concerned about growth in its domestic markets, and therefore the US economy will become increasingly insular, more concerned about growth within its own markets, and at the same time, it's going to be driven by domestic policies. As a matter of fact, the government has said that it will institute a situation where it will earn external taxes by tariffs on third-party countries. So that also is likely to stream into inflationary pressures in the domestic market. That might initially see the Federal Reserve's take a hold position, even though inflation rates are not where the American government would want them to be. They're targeting 2% currently, or at the last time the figures were released, we saw something around 2.9%, closer to 3%. Normally, we would have expected the Fed to decide to tighten, but as things are now, it's likely to hold. Our expectation is that the Fed will hold and see how things pan out, especially as relates to taxes and tariffs of external commodities coming into the United States. So that's that. We also expect that the United States government, as we have already seen, will try to claw back fiscal spending. That might be a hard task, as we have seen already that there's a pushback from Congress concerning the spendings on support structures that aid unemployed, healthcare, and a couple of other areas where they basically support fiscal support structures. The president of the United States says that it needs to be reviewed and perhaps scaled down. So we'll see increasingly contractionary fiscal policy and not necessarily an expansionary, but a modest monetary policy growth over the term of President Trump. And that has outcomes for the United States economy and the global economy, which we'll discuss later. In Europe, for instance, we expect to see countries like Germany sticking to very tight regimen of monetary policy and fiscal policy. France may not have such a latitude. Germany has a government that is more far right, and therefore its policies are very consistent with the policies of the United States of America in terms of fiscal and monetary conservatism. In France, you have a rather loose confederation, or let me say rather less cohesive party arrangement. That means that it may not be so decisive in implementing monetary policy and restraining fiscal expenditure. So the outcomes for Germany and France, unlike we had seen in the early 2000s, may not necessarily work in tandem. Germany is likely to go in one direction, and we'll see France actually going in a slightly different direction. And that will also influence their markets, and that's why we're saying that the equity markets in Europe will be a bit mixed. Some will do better than others. We see a stronger equity market in Germany, a softer equity market in France. Right. So the next thing I want to treat on the global market is actually the commodities market. Our outlook for the oil market is that oil prices will come under $80 per barrel on average. If the Americans can ramp up their oil production beyond the 13 million barrels per day they're currently doing, based on the president's policy of drill, baby, drill, we will see a greater supply of oil coming from the United States of America. In the interim, both Saudi Arabia and Russia are likely to hold their positions. But how long that will last, we're not too sure, because there could be a situation where the Russians, as well as the Saudis, believe that it's not in their best interest to lose global market share, because America does 13, both Saudi Arabia and Russia do sub 10 million barrels per day. So that will influence international crude oil prices. Our prediction is that international crude oil prices will settle anywhere between $75 and $79 per barrel in 2025. Geopolitical tensions will perhaps, in some instances, worsen, and in some other instances, soften. But generally speaking, it's really a game of possibilities. In ProShare, we talk about interpretative possibilities. So really and truly, how that outcome will look like, we're not too sure. But for us, it is what we call the known unknowns. We do not know the exact magnitude of some of these political shifts, but we're sure that those shifts will occur. So there will be shifts concerning the Russia-Ukraine difficulties. We'll also see some shifts in the Middle East, perhaps brokered by the United States of America. So we could perhaps see some resolution of the Israel-Palestine challenges, while there will be some resolution of the Ukraine-Russian tussle. How well it works out, like I said, it's basically unknown, but there will be efforts at reducing the severity of global tension on that stage. We also, because of the tightness that is going to happen, the tightening that we expect to happen in the United States of America and the government's imposition of trade tariffs, one of the things that we're looking at is that the American economy might soften a bit. The extent to which it is softened, we can't say currently, but there are indications that it will get a bit softer. We expect that there will be some bearishness in US output. Hopefully, it may not be too severe if other parts of the world do not engage in what Dr. Okonjo-Iweala had called a tit-for-tat economic diplomacy, where situations where, for instance, America imposes tariff and some of the Eastern economies also impose their own tariff, and therefore global trade generally begins to shrink, which will affect mid-sized countries as well as small-sized countries. We are hoping that that outlook doesn't occur. but we haven't seen any signs to suggest the severity of that outcome. But we know that there will be attempts to some extent to maybe push off the adverse effects of the American tariff on imported goods. Now, another important thing for us is metals, solid metals in the commodity market. We believe that solid metals like platinum will see a decline. We're looking at already year to date, you've seen a decline of roughly, I think it's 9.5%. Yes, we've seen a 9.5% decline in platinum. We think that that may continue depending on America's extent of America's trade tariffs and the bilateral trade agreements that the American government engages in over the next couple of months. Now, for platinum, part of the issues will be the demand for automobiles, energy transition, geopolitical events, and increased demand for green hydrogen. Now, that's a critical issue because the new American government seems not to pivot towards the previous government's concerns about greenness and environmental issues. And given that fact, there will be a slowdown in the alternative energy market. And that could adversely affect companies that are within that economic space, as well as commodities that feed into that economic space. We also see challenges with palladium. Palladium year to date has gone down, I think it's 18.5%. Yeah, that's 18.5%. Palladium has gone down by 18.5%. This may continue because it's also factors that affect platinum that also affect palladium. Yeah, so international commodities market, that's what we see there. Crude oil, I've already discussed, and I've said we think that the crude oil price would be much lower than, consistently much lower than the $80, $82 per barrel we saw early in the year and late 2024. Yes, so now geopolitics. Once somebody told me, a prominent economist said that, look, politics will always trump economics. And the pun was unintended, but politics will always trump economics. And we have seen that play out in the way the world is evolving. We're seeing the world evolve into, we see a transition to a new global order. Nigeria become a partner of the BRICS nations. And we see other collaborations taking AES. We've seen them form their own bloc. And the interesting thing about the AES bloc is that these countries have more or less carved a niche for themselves and appear to be the fastest growing economies in sub-Saharan Africa. So those who are interested in investments, perhaps in Africa, particularly sub-Saharan Africa, would perhaps want to look at some of these countries. You take, for instance, Cote d'Ivoire will grow at about 5.7% by our own estimate. Niger will grow by about 5.2%. How's that relevant? Well, we project that Nigeria in 2025 will go somewhere around 3.2%. And this 3.2% is lower than Nigeria's average. When you look at between 2013 and 2023, I think, yes, 2023, the growth rate, the average growth rate was about 3.8%. So the 3.2% is lower than the average, but it's still one of the highest growth rates Nigeria has experienced in recent times, in the last 5 years. So it's not a sub-story. Nigeria will definitely grow, but it needs to grow faster. And we may have that conversation somewhere towards the end of this presentation on what Nigeria needs to do to be able to grow at a faster pace. We're also seeing different combinations of countries, as you might see in my slide, forming different alliances. But the truth of the matter is that these alliances may not count for much if it shrinks global trade. Global trade is critical to how these alliances become meaningful in the general scheme of things. Now, if we have more multipolar relationships, what that means basically is that you have islands and pockets of different sized economic groupings trade within itself. It shrinks global trade. So global GDP might actually shrink, certainly in 2025, but maybe less so in 2026 when the kinks in the systems and the bilateral relationships work themselves out gradually. And one of the things that I would like to mention that we see happening is overlapping cycles of conflicts. I just mentioned the AES. The AES used to be part of what we used to call, what we still call actually, the Economic Community of West African States. So 3 nations are pulled out. There are some nations that are lining up to join the AES, which creates fracture within the Economic Community of West African States. And that could have some negative consequences for progress concerning integration of the economies of West Africa, and perhaps the ability to fast track a faster pace GDP growth amongst all nations within that sub-region. And we're seeing something similar in Europe, where certain European nations are not falling within the prescribed band that the EU expected. So we see France and Germany, rather than working in tandem that we had seen them in the past, they're gradually pulling apart in terms of their inflation rates, GDP growth rates, trade figures. So those overlapping cycles of conflicts will be prominent in 2025, but they may not necessarily be deal breakers. There may be ways by which these countries will resolve those issues. Right, so we look at these geopolitical developments and new investment shifts. For America, we see declining influence in sub-Saharan Africa. We see declining trade with sub-Saharan Africa. We see declining investment with sub-Saharan Africa. We see declining manufacturing in sub-Saharan Africa. So these are critical things where when you look at the United States of America and the new far-right disposition of the newly elected American government. So we're basically seeing a lot of decline in their interrelationship with sub-Saharan Africa. Asia, on the contrary, we see rising manufacturing in sub-Saharan Africa. We see increasing investment with sub-Saharan Africa. We see increasing trade with sub-Saharan Africa under the aegis of the Brazil, Russia, India, China, South African BRICS arrangement. We see a greater amount of integration of economic activity between these nations and sub-Saharan Africa. We also see, of course, that there will be rising influence of these nations in sub-Saharan Africa. We're already seeing that in Nigeria, for instance, where several manufacturing concerns are springing up in different parts of the country, but most notably within Ogun State, where we have different Chinese companies manufacturing different products and engaging very young Nigerians in meaningful employment. That's the kind of pattern that we've noticed in Nigeria. But that pattern is also significant in other countries such as Uganda, Zambia, Ethiopia. So it's not a pattern that is primarily restricted to West Africa. As a matter of fact, there is a book called The Next Factory of the World by Irene Sun. And she points out that the next frontier for manufacturing growth and development is actually Africa. And that's why we're seeing increasing amount of Asian investment, because they're looking at the future of manufacturing. Okay, so what are the takeaways for Nigeria from what we've discussed so far? Supply chain disruptions will definitely continue as conflicts continue in geopolitics. That will have some adverse effect on our access to goods or commodities at fairly quote unquote reasonable prices. The global economy will remain relatively fragile, at least for Q1 and Q2 2025. And this will create some amount of volatility in commodity imports into Nigeria. And that could also affect domestic inflation rate. The fragile growth in Europe. Europe is also a significant buyer of Nigerian products. So fragile growth in there, and it's not just fragile, it's also fragmented growth in Europe. We'll also have some downside risks for Nigeria. So we also see oil prices declining. And of course, the bulk of Nigeria's foreign exchange revenue comes from oil. So a decline in oil prices may see a reduction in external reserve growth, not in absolute numbers, but in the growth of the external reserves as oil prices decline, unless we are able to make up for it by increasing the quantity of oil, crude oil, that we actually sell. Recently, the government said the production is actually about 1.9 million barrels per day. Figures available to us suggest that it's 1.5 million barrels per day plus condensate. So we are waiting to see the National Bureau of Statistics or the central bank providing us the basis for the 1.9 million barrels per day. But we prefer to be rather conservative and put it at somewhere between 1.52 and 1.56 million barrels per day, including condensate. But if we're going to compensate for declining oil prices that we see in the first quarter and second quarter of 2025, we'd love to see a situation where Nigeria can ramp up actually its oil production to compensate for the decline in price. And so we'll be able to protect the gradual improvement in our foreign reserves that we've noticed. And we'll get back to this foreign reserves issue because it also influences the extent or the severity of domestic inflation and explains why, despite the continuous tightening of monetary policy by the Central Bank of Nigeria, we have not yet been able to handle this monster effectively. So fiscal policy. Nigeria currently has a debt to GDP ratio of about 58%. No, sorry, 52%. It's 52%. And then the debt service to revenue ratio is about 58%. That's relatively high because even the threshold for the World Bank, when you're looking at nations and their fiscal stability, puts the most appropriate ratio of debt to GDP to not exceed 40%. And we're already doing way above 40%. So it has caused a lot of concern for manufacturers, for academics, and for investment advisors, such as Apel. So we have to take the fiscal policy issues at the scruff of his neck and address that. And we'll talk about, okay, let me just chip in something here. Now, in ProShare, we have what we call the whole of government approach to solving certain national economic challenges. And we have consistently advocated that the government needs to shift away from income statements where you're looking at your incomes and you're looking at your expenditures. That's brilliant. I mean, it's conventional. But when you are in a hole, convention means very little. Actually, what takes you out of the hole is being unconventional. And therefore, we've advocated consistently that it's about time Nigeria looks at its assets. We should become increasingly more asset-centric rather than income-centric. So rather than just looking at revenues and the expenditures, we should look at what are those assets available to the country that can either be leased, sold, or privatized. We're convinced that Nigeria has sufficient assets to assist us in shoring up our foreign reserves, to initially between $60 and $80 billion. We'll be in a great position to reduce the domestic inflation rate. And the consequences of that we'll discuss as we go through the presentation. Yes, and then our big brothers, the other side of fiscal policy is monetary policy. Since 2023, the federal government has decided to revert to an orthodox monetary policy arrangement where the government insists that it's going to target inflation, and its primary concern is to bring inflation down. That's laudable, and we do commend the federal government and the central bank for taking such a stern and strong stance on inflation. Why? Because inflation is a massive tax on the average Nigerian citizen, especially the households. Households have found it extremely difficult to cope with the situation we find ourselves in. Standards of living have dropped significantly as cost of living has risen significantly. So our argument, therefore, is whatever can be done to reduce the domestic inflation rate and make domestic inflation more consistent with what will attract foreign investors, the better for everybody. The small-scale industry, the large-scale industry, the average household, the individual will all be better off with lower inflation rates. But we don't see that happening by using conventional methods. The thing that will do it for us would be to improve our foreign reserves. Between 65 to 70% of the domestic inflation can be tied to our foreign reserves, our lean foreign reserve position. That's one of the reasons also why we are seeing that it's more or less like Saudi Arabia fixes its exchange rate relative to the United States of American dollar, but that's not true. The truth of the matter is that the massive amount of exchange resources, foreign exchange resources they have, makes them intervene effortlessly, creating a semblance of fixedness. But there are variations, but there are variations within very narrow band. And that's where we think Nigeria should be headed. We need to improve our foreign reserves. And we think that between the fiscal and monetary policy, monetary authorities, we should be able to come up with solutions, especially on the asset side of the balance sheet, to improve our reserves, bring down domestic inflation, bring down domestic interest rates, and improve the cost of funds to manufacturers and other economic entities within the Nigerian economy. Globally, we're seeing a lot of coalitions. We're either seeing nations pivot towards the far right, or we're seeing coalitions. These coalitions have been basically fragile, and they are not likely to bring out the results that will favor countries in sub-Saharan Africa. So we'll prefer not to really concentrate on that. But sub-Saharan Africa has to be prepared for the consequences of far-right economic policies, which will be dominant and will affect countries like Nigeria. We have talked about trade blocs and how trade blocs are likely to shape the conversations around trade. We expect Africa to do better if it can improve the speed at which we actually implement the African Free Trade Agreement. Also, the Pan-African Payment System, PAPS. And in terms of the equity market, the African Exchange Linkage Program is also going to be critical from 2025, so that it enables a Nigerian to easily buy equity in South Africa. It will also enable a Ghanaian to easily buy equity in Nigeria. We should be pushing those agendas very strongly. And we believe that with the strengthening of commitment towards the AELP, the AFDP, and PAPS, Africa should be able to reduce the severity of the contractionary headwinds we see ahead as a result of the narrow trading blocks the world is disintegrating into. Yeah, so I'm quickly going to run us through the Nigerian economy, sectors, and market insights. As a brief introduction to this, I had said earlier that ProShare looked at 46 sectors that are usually published by the National Bureau of Statistics. And we've decided that, look, could we compartmentalize them in such a manner that we can identify what are the foundational drivers of the Nigerian economy? So we attempted to do that in our NCM report, Nigerian Capital Market Report. I would like our audience to check the ProShare website and download the report, and you will have insight into what the consequences of our discussion around compartmentalizing groups of sectors into sub-economies. And I'll get back to that issue. But here I present Nigeria's macroeconomic dashboard and our outlook concerning the dashboard. We're looking at the dashboard between 9 months 2023 and 9 months 2024 and the percentage changes. Here, I think the data speaks for itself, so I will not dwell too much on it. I'll also, okay, I could look at this briefly. In ProShare, one of the key themes in ProShare's approach to looking at the Nigerian economy is to use the household as the primary unit of economic study, the significance of the household. And we did that in our economic outlook in December. And this, the presentation you are seeing now is the outcome of that. We looked at minimum income, the minimum wage as of October 2022, as well as the minimum wage as of October 2023. And then we looked at the minimum wage as of October 2024. And we looked at the 2-year increase in that income. And then we looked at a couple of other things. We looked at things like food inflation. We looked at things like cost of healthcare. We looked at the misery index. And so all those things that you see here in red are the signs that there is a softening of the Nigerian economy. Those things that you see in green shows where we have turned a positive trend. We've done well in opening new accounts. PS transactions have risen significantly over the 2 years, 62.86%. Number of times the national grid has collapsed is one of the negatives. That went down 25%. But the important thing here is that the positives, POS transactions went up 195.76% over the 2-year period, which does seem to suggest that what we call the digital economy serves as a foundational driver of the Nigerian economy. And here we're going to have to talk about that in greater detail. Right, so the next slide shows inflationary pressures and sustained growth amidst orthodox policy rate approach. Now here, it's a very simple thing. We look at real GDP growth. It has virtually crawled between 2006 and 2024. Now, let's look at the average policy rate since 2006. We see a gradual rise in the average policy rate, but inflation has also risen. Why is that a matter of concern for us? It is a matter of concern because the theory says that when you tighten interest rates, inflation should actually decline. But the data doesn't bear that out. The data shows that as we've tightened those rates, inflation has actually increased. I know people say that Nigeria is a special case, not necessarily so. The truth of the matter is that from ProShare's study of the macroeconomy, the monetary policy rate has a great influence over the short-term transactions between the monetary authority and the various domestic banks. That is true. However, when it comes to commercial rates, the monetary policy rate has very little impact, perhaps only as a signaling rate. But even at that, it's weak. The signaling effect is weak. So therefore, we've seen a situation where monetary policy tightening has not necessarily translated into inflation containment. And that brings me back to what I said earlier, that one of the approaches that we prescribe for addressing that inflationary challenge is to look at how we can use our assets. We sell down assets. For instance, we could sell down our equity in joint venture agreements with oil companies. That would bring in cash, dollar cash. We could also say that, okay, we have a couple of idle assets, the National Stadium, Surulere, Federal Secretariat, Ikoyi, a couple of other items like that. These are just placeholders for items that are spread across the country. They are idle assets, but they are also active assets. The active assets will be state-owned enterprises that are continuously operational, but they are not optimally run. So we would, for instance, argue that the National Petroleum Corporation, Nigerian National Petroleum Corporation, should be unbundled into its different segments, downstream, midstream, upstream, and sold, equities sold independently on the floors of an exchange of choice. It could be the NGX, it could be FMDQ, and it could actually be a dual listing where we're also listed on the New York Stock Exchange or even the Johannesburg Stock Exchange. But for us to be able to identify value and derive value from those assets and ensure efficient governance of those institutions, we need to place those entities in situations where they become more effective in serving the Nigerian people. So the next slide shows inflationary pressures, sustained growth amidst policy approach. Just another twist to the earlier slide. Okay. So we took a look at Nigeria's monetary and fiscal policy measures in 2025, and we gave our perspective as distinct from perception. Our argument is this: monetary policy has three possible approaches in 2025. The CBN's monetary policy, they could decide to tighten because inflation is currently at 34.8%. There was a 20 basis point increase from 34.6% in the month prior. So they could decide to tighten. They could decide to remain neutral and hold. Or they could decide that, look, you know what? We want to see more growth in GDP. Therefore, let's loosen. This is the most unlikely outcome. We believe that the outcomes will be between, in 2025, especially in the first quarter, will be between staying neutral, taking a hold position, or tightening. But our concept is that even if we do tighten, we are not convinced that inflation rate will be moderated. But there is something that will moderate inflation, and that is rebasing. I think either Thursday or Friday, the National Bureau of Statistics will come out with its revised inflation and GDP figures based on a different base. The earlier base was 2010 for GDP. The same thing for CPI, that was Consumer Price Index. We expect that with the adjustment, we're moving to 2019 for GDP. And then for inflation or CPI, we are moving to 2024. Now, those adjustments will mean that our GDP will go higher and our inflation will become lower. So how does that affect anybody? Well, first and foremost, as seeing our inflation go down will give you a feel-good factor initially. Gives you a feel-good factor that, oh, okay, fine, inflation is coming down. But inflation coming down does not mean that prices will come down. I need to make that very clear. Does not mean that prices will come down. All it is saying is that prices are changing at a slower rate. So it doesn't mean that everybody goes to the market and a bag of garri suddenly drops to 40 naira per 50 kg bag. No, that won't happen anytime soon, except we perhaps look at the school of thought that has been pushed by a number of economists that Nigeria needs to take a second look at its assets. And maybe I should just chip in here now. Some of those assets are lying on prime property. There are some institutions of government that lie on prime property. The argument of this school is that why don't we repurpose those properties, take value out of those properties and rebuild barracks, for instance, somewhere else, while we take the value of those properties and use it to intervene in reducing the size of our domestic and international debt, which gives us greater breathing space fiscally, or we take it to improve the level of our foreign reserves. That's a school of thought to which pro-share analysts have made contributions to that school of thought, but there are contending school of thoughts also who believe that that's not the way to go, and they have a good reason to suggest that their position, to argue their position. So for us, we see a situation where there'll be relatively high borrowing costs in 2025, unfortunately. We were at a meeting yesterday where a telco giant complained bitterly about its cost of financing, which is in the region of 30 to 32%. Now, if a preferred lender or prime lender, or a prime borrower rather, if a prime borrower is borrowing at 30 to 32%, you can imagine how much a non-prime borrower will be borrowing money. It will be almost impossible to turn a profit. And that's one of the pressures that some of the telcos are currently facing. So what we have seen from 2023, 2024, going into 2025, has been the crowding out of the private sector in the domestic borrowing or lending market. So there's been a crowding out. Most loans have gone to the public sector, and that has meant that the private sector have not had the capacity to be able to grow at a pace that will take us to the government's aspiration of a $1 trillion economy in 2030. So some of our policies need to be realigned such that we are private sector led, and that these policies pivot towards us seeing how the private sector can make its contributions towards growing the economy, particularly the capital market. One of the things we note here in terms of monetary policy is that we have not leveraged the capital market, we've leveraged the money market. But growth requires long-term funding, and therefore the capital market needs to be viewed with a closer eye on instruments that can enhance our growth rates. Okay, in terms of fiscal policy, like monetary policy, there are three outcomes that are possible. We could see tightening of fiscal policy, we could see neutral fiscal policy, or we'll see a loose fiscal policy. It's unlikely, again, here that we'll see that looseness. Already, we've seen the central bank with great commendation on our part for the governor's direction on insisting that he would not allow Ways and Means, which has been a bogey bear for the Nigerian economy in the past. He has insisted that that won't happen under his watch. And we're seeing the benefits of that. There's a greater amount of fiscal discipline. There's a greater amount of depth of rethinking strategies towards improving the economy through means other than borrowing, which actually funds the inflation we saw earlier. So do we expect to see do we expect to see tighter monetary policy, tighter fiscal policy? Not necessarily. But it won't be as rapidly expanding as it has been in the recent past. That's our take on that. So the possible outcomes is that our fiscal deficit may not change if we don't take an asset-centric approach. We'll still be locked in the income-centric mindset that will still see a massive debt to GDP ratio, a large debt to GDP ratio, a large debt servicing to revenue ratio. We've got to get those ratios down. It's important. We need to get investment where Nigerian sovereign bonds are rated at BB+. To do that, we need to bring those debt numbers down to show that we have greater fiscal control and stability. We also need to creatively apply our assets, both active as well as shrinking the domestic deficit, budget deficit, right? Now, an interesting point here in the next slide is basically how does Nigeria attract foreign direct investment? How do we attract foreign portfolio investment? Foreign portfolio investment has been on the uptick recently. we've seen in the last 3 years, we've seen a situation where 60% of investors in our stock market have been local and 40% foreign. Now we're gradually seeing a bit of change in our equity market and coming into the equity market to look at where there are opportunities. The major problem here is that there are very few assets to be able to trade. So pricing might actually be rather inflated. Valuations may actually be inflated because the market is relatively narrow. We need to use the capital market, the stock market, to expand or increase the width and the depth of that market to attract greater amount of domestic and foreign investors. Can it be done? Yes, it can. One of the ways we have suggested is that state-owned enterprises should be listed on the Nigerian Stock Exchange or the FMDQ as quickly as possible. And we've seen that happen in the 1970s when the military administrations in those days actually spurred capital market development or stock market development through the public listing of state-owned enterprises. Now, another area we're looking at is diaspora. We've toyed with the idea of a diaspora bond, our aspiration of growing the capital market. But there's something that is also equally important. We need to establish the fact that the capital market in Nigeria needs to be looked at beyond an avenue for placing money for returns, simply just investment. We need to see the capital market as a platform for mobilizing long-term capital. So the private sector can say, you know what, I'm going to the capital market, I'm going to list equities, or I'll list long-term debt for the purposes of expanding my business opportunities in the local market. So far, that hasn't occurred. It's one of the reasons why currently, if you look at the 2024, we saw a situation where we had only 3 new listings on the market. And even those listings were by way of introduction. It wasn't by way of actually raising fresh funds. And now, the other flip side of, in the same year, we saw 13 delistings. That is companies that decided to walk away or as a result of repeated regulatory violations were told to walk away. Put a caveat here. That is not uniquely a Nigerian phenomenon. When you look at the London Stock Exchange last year, 2024, the London Stock Exchange saw only 18 new listings, but 88 delistings. So there does seem to be a pattern where, regardless of markets, whether it's an emerging market or a mature market, people are looking at the stock market as mainly a place where you can make returns on investments, short-term returns on investment, rather than a place to mobilize long-term funds. And one of the things that could happen to encourage that, in our opinion, is that incentives should be adopted to encourage those people who list on the market to actually be able to differentiate themselves from those who are not listed. And one of the ways we're looking at is the Tayo Committee on the tax administration in the country, the fiscal and tax administration in the company. We are saying that there should be some tax advantages that are given to companies that on any of our exchanges, where there should be some tax encouragement that will perhaps make companies stickier on the exchanges, or it will encourage those who are not on the exchanges to come into the exchange because shareholders want that advantage, that tax advantage to occur. So we recommend that may be a way out, encourage investors to come to the capital market to raise funds. Okay. Here, I'll just give you a quick look at some of the performances we've seen in the capital market for the year 2024 as at the end of the year. We've seen some companies show declining value. They've actually not lived up to their billing. And they're in sectors that are rather surprising because there are opportunities within those sectors. These are the companies that have not done rising because you won't expect ICT and oil and gas companies to have poor performances on the exchange. I mean, oil prices went up on the international market. So with high international oil prices, you would expect that oil companies would have done a lot better, seeing improved profitability, and hopefully for those that have declared dividends consistently, we'll see higher dividend yields. That has not happened. ICT, we've also seen challenges. For instance, you can see on our slide here where we have one of the ICT giants, perhaps one of the biggest, the market yield declined 24.24%. Why was that? Now, the major challenge here was actually as a result of domestic price increases, number one, security challenges, number two, and then foreign exchange problems, because the ICT sector is it's foreign facing. Most of the equipment and things that they require to sustain services are imported. So when the foreign exchange rate swung from about 480 to 1,600, and as a matter of fact, at a point got up to 1,900, and people were afraid that it would get to 2,000, it had adverse impacts on the ICT companies. And so many of them currently are, contrary to the positions they had 3 or 4 years ago, they had declared losses. A few of them will soon come out with their 2024 audited annual accounts. We're not seeing much change from there. The difficulties will still persist. However, with the government's agreements to allow them adjust tariffs, there might be a clawback, and they will be able to improve their performances going. The weather is still inclement, but 2025 might see some improvement. It doesn't mean that they're out of the woods, but it does mean that their financial performances should improve substantially. So we're looking at the FX market. If you look at this screen, you'll see that if you look at between January 2024 and September 2024, the NAFEM rates and the BTC rates mirrored themselves, except at the earlier part of 2024. There was definitely a spread. Before we got into March, that's the end of the first quarter, we started seeing a mirror effect. And for most people who are concerned about foreign exchange, this was a good development, a really good development, you know. But unfortunately, at the point in time when the CBN, and surprisingly too, not just unfortunately, but surprisingly, when the CBN decided to embark on automation, we started seeing a reopening of the spread between the NAFEM rate and the BDC rate. When the CBN, sometime in December 2024, decided to introduce the Bloomberg portal for digital foreign exchange transactions, we saw an appreciation of the Naira, as well as an appreciation of the Naira in both markets, the NAFEM market and the BDC market. However, immediately after that, we started seeing a widening in the spread between both markets. This issue is one that needs to be addressed urgently, because one of the arguments a school of thought had at the time when there was the decision was made harmonize the parallel exchange rate depreciate, while the parallel exchange rate will appreciate. Even institutions such as JP Morgan had estimated that we should see a convergence around 800 to 900 Naira per dollar. That hasn't happened, and it's not happening now. And there's still a persistent widening of the spread between both markets. This, we believe, are issues that do not feed into the narrative that will encourage foreign direct investment and even foreign portfolio investment. This next slide shows money market rates. I had said, I had said earlier that the monetary policy rate tends to influence more of the short-term money market rates between financial institutions. So you can see the variability and the rise in the open repo rate, as well as the overnight rate. So those rates that are basically financial institution-led rates between themselves respond to monetary policy rate rises. But if you look at the maximum lending rate, there's variability, but it's fairly flat. That rate is very flat. So lending rates don't respond to MPR. And of course, deposit rates, savings rates also don't respond to MPR. You see the move or lighter purple line along the bottom of that chart. You see that's the savings rate. The savings rates have been typically low, giving banks significant spread between lending and saving rate. We could have a debate another day from different schools of thought, but our contention is that there is a need to rethink the monetary policy approach. Perhaps one of the ways that would help the economy is to reduce not necessarily the MPR to the banks so that they can on-lend it at lower rates to the real sector of the economy. As long as the real sector is growing, we feel that with the accretion to the foreign reserves, inflation will not likely accelerate. Here, we give you numbers on the local commodity markets and how that has changed. We have talked about the international commodity markets and our expectation. Here is our expectations on the local commodity market. We see significant rise in 2024. Gold for the year had already risen 77.8%, maize 42.98%, paddy rice 63%, cocoa 200%, so commodities did fairly well last year. Now the issue is, will they do so well this year? The answer is it's a known unknown. Yes, they will do well if global trade does not implode, based on the, like we called it earlier, multipolar world that we are gradually entering into with bilateral trading relationships between nations, closing down the openness of the international market and the competitive pricing and the competitive supply of goods between nations. That will maybe one of the sore points of some of the policies we're seeing in the higher income economies of Europe and the United States. Right. So here I give a snapshot of our expectations concerning economic outlooks for different institutions. The World Bank sees Nigeria's GDP grow at 3.7%. Inflation will moderate to 21%. International Monetary Fund agrees with ProShare, or let's say is in alignment with ProShare, seeing the growth rate, GDP growth rate in 2025 at 3.2%, with inflation at 25%. ProShare actually sees inflation at between 25 and 27%. Anywhere between those figures is likely to happen based on rebasing. However, I must say the public officials have stated that they believe that inflation will come as low as 15%. We are skeptical about that. We feel that that might be too generous an outlook. So we don't see that. Now, the Nigerian Economic Summit Group has also had a perspective that GDP for 2025 should grow at 3.2%. Now, 3.2%, as I had said earlier, is lower than the 3.8% that we've seen for the last 10 years between 2013 and 2023. The growth rate for sub-Saharan Africa, for instance, has been about 3.8%. But we have seen countries in sub-Saharan Africa, such as Cote d'Ivoire, Niger, break out of that by growing between 5.2 and 5.7%. CFG Advisory has said they see GDP growth rate being suboptimal, and they still insist that inflation will be relatively high. Economic Associates has the same outlook. FDC thinks that growth rates will be around 2.8%. They're more conservative. They see more headwinds than many other analysts. And they also believe that inflation will be around 33.1%. But I guess that consideration does not take into account rebasing. So this is prior to rebasing. The rebasing numbers will be different. If I should say that. Zcrest Research and then ProShare Research. So these are our numbers. Now, what are the scenarios that we can come up with concerning Nigeria in 2025? As an organization, we are very optimistic about what the possibilities are. We came up with an NCM, National Nigerian Capital Market Report, where we talked about the explorative interpretation of possibilities. What does that mean? Simply, that what are the possible outcomes if we take certain policies? So the best case, we felt that GDP could grow at 5.6%, inflation could come down as low as 16%, exchange rate will come down to 1,400 naira to a dollar, unemployment rate will come to 4%. Now, the unemployment rate quoted here refers to the International Labour Organization unemployment rate, and not the traditional unemployment rate that was previously quoted by the National Bureau of Statistics. So this is ILO unemployment figure calculations. So our base case expectations is that inflation could, GDP could grow at 4.3%. Inflation may become around 23%. Exchange rate settle at 1,650, and unemployment will stay at about 4.6%, just under 5%. Now, worst case, we feel we'll have a situation where GDP grows at 2.4%. We see inflation at 36%, which means that inflation will be worse than the 34.8% currently. Exchange rate could rise to 2,200 naira to a dollar, and then unemployment could rise to just under 6% at 5.7%. We don't believe the worst case will happen. We believe there is a capacity for Nigeria to swivel towards the best case if certain policies are taken. But basically, these are our own outlook concerning major macroeconomic indicators for 2025. Here we just look at the top performing stocks in 2024. And I think we could skip that. Yep, I think we could skip this also. Yes, so let's come to the issues of rebasing. The rebasing figures, like I had said earlier, would likely be released, if not tomorrow, by Friday. But we need to understand that there will be two figures. One figure will look at the GDP without rebasing. The other will look at the GDP with rebasing. And then there will be an inflation rate figure. And we need to be quite clear. The inflation rate figure does not use the new 2019 base for inflation. It uses 2024. Now, given that, it means that the inflation figures will come down significantly. So the 34.8% will come down. The GDP, our expectation for GDP is that the GDP will move anywhere between $350 billion to $490 billion, depending on the sectoral composition, the weights assigned to each of the sectors. Now, why I'm saying this is this, to make it a lot easier, is that over the last 3 or so years, we've seen a massive rise in the contribution of the creative industry. That industry hadn't been actually integrated into our GDP figures appropriately. We also have what ProShare calls the lifestyle economy. that economy also has not been fully integrated into our GDP calculations. So there are certain sectors or sub-economies that ProShare has identified that with the appropriate weighting, we should see a significant improvement in GDP that takes us as close as we can get to our desired $1 trillion economy. There are a lot of activities that we consider hidden. And those hidden activities could bring in an additional $146 billion if properly captured. So we feel that it is possible that we could end up anywhere between $350 billion and $490 billion, depending on the weight and depending on the extent of expansion of the number of sectors in each of our own sub-economies. So that's for that. So for our calculation, we looked at, if you look at the figure here, the tables here, the charts, we rebased in 2014, the GDP. And you saw the climb from, from where it was, which was about $480 billion to $510 billion in 2014. But we rebased inflation also. And then we saw that inflation also declined. So we see the same pattern occurring. However, the size of the change is what we don't know. That's number one. And if you look at the inflation figures, they dropped in 2014, but they steadily rose again from 2014. By 2015, that the inflation rate has started rising. It didn't decline until 2017, which was at the heart of the global recession. So after the recession, it started climbing back up again. So hopefully, we should see a lower inflation rate. We should see a higher GDP growth rate. Excuse me. So those are two outcomes that we expect over the next 2 days. A lot of issues have been debated around the rebasing, but we would think that it would be prudent for us to wait for the National Bureau of Statistics to release its figures, and then we can have a conversation around that and how it will impact investment and investors going forward in 2025. So ProShare calculations have been placed here. So those who want access to it can talk to Apel, and I'm sure they will make that available for study. This still continues our extrapolative rebasing possibilities. Like I said before, these are scenario analysis of what could happen based on certain assumptions. So you could go through that quickly and have an idea. Right. So here is a concept that is novel to ProShare. It's called what we call the decagon of power. For ProShare, this decagon of power represents the combination of sub-economies that need to act together to be able to drive the Nigerian economy at a pace that will ensure reasonable levels of employment, lower levels of domestic inflation, and attract higher levels of foreign direct and portfolio investment. All these sectors that you see within this decagon of power must be addressed. And there are strong interrelationships, which have been highlighted in the diagram here. If those interrelationships are optimally used or consolidated, then we are likely to have a reason to smile in the next 2 years. Nigeria's situation has been difficult. Tough choices have been made, and that was almost inevitable. But it's not a story. It's not a sub-story or something that we should overemphasize. Ryan Holiday says the obstacle is the way. They make us more clear-headed. And that's what we see if we optimize this decagon of power. The administration needs to understand the interlinkages between this decagon and how the nodes can be integrated in such a manner to improve the overall welfare and well-being of the Nigerian citizen. The next slide identifies the 14 sub-economies that ProShare considered to be critical to the development of the Nigerian economy in 2025. These sub-economies are opportunities. One of the things I wanted to say is that I will not go into specifics of where investors can make some pretty decent returns, but these sub-economies identify the areas where there are a great amount of growth that we see over the next 24 months. There's great growth opportunities if that decadon of power is optimized into a grid, into an economic and political grid that provides the foundational enablers for the Nigerian economy to grow. We should see these sub-economies achieving a lot, including the digital economy that I had spoken about earlier, that currently suffers cost challenges that has resulted into some of the losses they have made, even though they have made, they are very big players and they have high market capitalization of over ₦1 trillion on the NGX. These companies are still bleeding cash, and they're having challenges with access to credit and the cost of credit and all that problem. But the opportunities are enormous. What we need is the combination of that decagon to work in tandem such that they can provide the enabling environment for the Nigerian digital economy to lead Nigeria to a place of sustained growth. As we are seeing in Kenya, as we are seeing in Rwanda, it's possible in Nigeria. This slide shows new growth areas. So with you can, like I said, collect the slides from Apel, and you see the growth areas, and we showed the principal drivers of those growth areas in 2025. Ladies and gentlemen, I want to thank you for your patience. I want to thank you for tolerating me for this number of minutes, and I hope that we'll all see one another at the top during the course of the year. Thank you very much.
Thank you. Thank you so much, Mr. Shitabe. Thank you so much, Mr. Shitabe. This has been a very insightful session. In short, I've been taking notes all through. I just wanted to reiterate to our attendees, for those who joined in late, that the webinar is streamed directly to our YouTube channel, so you can access the beginning part of this presentation via YouTube. So we'll be going straight to the Q&A session because of our time is fast spent. You know, we've had a lot to say today, and Mr. Shitabe has done due diligence on the topic we have given him at hand. So without any further waste of time, Mr. Shitabe, I don't know if you would want me to take all the questions at once, or we should take it in bits, maybe questions of 5, 10. This way. Yeah. Okay. So our first question, I have here, what are the best investment opportunities and risk investment at minimal risk in 2025? How can small-scale investors or young professionals tap into government policy for directions for investment? I also have here, which sectors are expected to dominate in 2025? Is it the oil sector, telecommunications, or any other? How will inconsistencies in government policies and new tax regimes affect economic growth and investment in Nigeria? I also have here, once again, what impact will Nigeria's BRICS membership have on its economy and investments? So I'll stop here for you to answer this question, sir.
Okay, thank you very much. These are really tough questions. People are putting me on the spot here, but it's fine. I really enjoy the questions, very intelligent questions at that. So let me look at the question of investment and risk. The primary principle of investment is that the higher the risk, the higher the return, right? So if you want an investment that's going to be a minimal risk, the thing you're going to do is to go and put your money in federal government's treasury bills and bonds. That's this thing, and the returns are not too bad, except for the fact that in recent times we've seen, in the past few days, we've seen that there's a tendency towards what is known as an inverted yield curve. What that means is that short-term rates on government instruments are higher than longer-term rates. Usually that is indicative that inflation expectation is declining. You expect that inflation going forward will decline. This actually would happen but that's basically because of rebasing, not because the underlying economy itself is generating the productivity that reduces overall price levels. So that's the danger. There's a downside risk there. But even in the United States of America, what we've seen is that in recent weeks is that short-term rates are high, medium-term rates are low, long-term rates are high. So you have a sort of a V-shaped yield curve. So what should you do as an investor? Well, if you're not fond of risk, I would suggest that you go into the treasury bills market. The yields are quite good. Yes, their real returns, are low, because if you adjust those returns for inflation, you will have a negative return. But it could be even worse, because if you kept your money at home, your whole value will just disappear. And so for me, treasury bills are in it if you are risk adverse. However, if you're not risk adverse, I would say that you should look at some selected equities in certain sectors of the economy. I'm not going to give details of which sectors, but we have them, we know them, and I'm not going to tell you which companies. But there are companies that are going to yield some very significant rewards in 2025 because of certain geopolitical factors, as well as certain government policy arrangements that we are aware of in 2025. And so that will improve the yield of those investments, both in terms of capital gains and dividends. If you want more details, I'll advise that you talk to the people at Apel. They'll perhaps sort that out for you, but I won't go into further details there. Apel does that very well. Now, small-scale investments. One of the challenges of small-scale investments in Nigeria basically now is high cost of funds. And that's why we were saying that one of the ways that we would hope that a school of thought will gain further prominence in public sector circles. And that school of thought is a school of thought that takes an asset-centric approach towards fiscal management. What I mean by that is that let's look at how we can sell down some of our assets. We can financialize idle assets, and we can securitize certain cash flows. Our JVs, we can sell them down for good money and raise good money and increase our foreign reserves. We could also sell down certain companies that the government, both at state and federal levels. We can sell down some of our equity interest in some of those companies. The government really doesn't have too much of a need to have 100% equity in any company. That's our position. We believe that the government could do well with having just enough stake to have a seat at the board, so that it knows what is happening in those companies. But it doesn't need to be the dominant shareholder, and we'll be fine. And we've seen situations like that. Let me give you an example. Last year, Egypt listed 32 public enterprises. So you had 32 state-owned enterprises being listed on the Egyptian exchange. Those are the kind of things that we think Nigeria should do, so that it will bring down prices. And when it brings down prices, it's also going to create a situation where inflation declines And as that goes down, as inflation goes down, nominal interest rate, that is interest rate as measured against inflation, also declines. So lower interest rates gives greater access of small-scale businesses to credit. But I must say something. If you're a nano company, that's a very small business, or a small-scale business, debt is not your best option. It's not your best friend. It's better for you to initially look for family and friends to support your business with equity. And as you scale that business, as you understand your cash flows, you can now use that to leverage a certain amount of debt, and that will be fine. But small-scale businesses, as far as we are concerned, shouldn't really take on debt and overtrade. So small-scale businesses should look for cheaper sources of funding. What I think in the literature is called black taxes. So I go and meet Ngozi and say, hey, my sister, see my business plan. Don't worry, in 24 months, based on this plan, I should be able to do something. And Ngozi, I know she's very cash heavy. So Ngozi brings out a slice of that cash and decides that, okay, you know what, I can give you a fraction. So I'll give you 10%. If I get 10% of what I need from 10 people, I've got 100%. And then I can now use that money, and invest. Because in the short term, for small scale businesses, you don't want to be over leveraged. Now, inconsistency in tax and growth. That's a difficult one to answer, because I don't really see the question of inconsistency. I see a situation where we have been locked into a tax regime that requires review. And the federal government has done that through the Taiwo Iloyede Committee, where they have reviewed the taxes and opted to harmonize those taxes. So for me, let's wait and see what the outcome of the Oloyede Committee is. And if we're not satisfied, we can call for a tweak of that tax. Like I said, one of the things I've said, earlier in my presentation was that I would love to see a situation where listing on any of our exchanges, either the NASD, NGX, FMDQ, when FMDQ decides to trade equities, there will be a tax advantage. So the company, if, for instance, you're not a listed company and you're paying tax, maybe you're paying 30%. So if you're listed, you pay 25% corporate income tax. So there's an incentive for listing. That will encourage more people to come to the market, and it will also encourage small-scale investors. How? Through what is called a mutual funds. That's a pooled investment scheme where small investors can pool their money together and buy shares in large companies that are currently in growth areas that Proshare believes are growth areas to look at, which I said I will not name. But there are these growth areas, and you can pool resources together. You could even actually form an investment club, which Apel can advise on. You form an investment club, very small set of people. Every month you put something aside and you buy into these very strong companies that are going to do exceptionally well in 2025. So that's what I see in that area. So there will be growth if we do those kind of things. And then I think the last one for me is the BRICS. And we're talking about impact of Nigeria BRICS. Well, that's a very good question. Why would you want to get into a trade bloc? To what extent has our presence in OPEC enabled us to accelerate growth? And if a certain situation is convenient or favorable at a time and your reality changes, should you change your position and decide on doing something different? That's the question all of us will need to answer. OPEC at the point served a great need for Nigeria, especially in the 70s up to the 80s, where under the cartel, we were able to attract higher amounts of higher prices for the oil that we sold. So we sold a lot of oil at high prices, and that should have formed a source of driving economic prosperity. Why it did not? The answer, your answer is as good as mine. But the thing is that I believe that those who opted to consider BRICS as an opportunity for Nigeria saw something that has evolved. First and foremost, I had said in my speech that if you go to Ogun State, especially along the expressway, Many of the companies that are there are Chinese companies. As a matter of fact, Shalima is also there. That's a pharmaceutical company. That's an Indian pharmaceutical, is a global Indian pharmaceutical company. So India and China are investing heavily through foreign direct investment in Nigeria. Like I said, Irene Son said Nigeria and other critical economies in Africa are the next factory of the world. Those BRIC nations, they're not saying they're coming. They're here. They're already investing. So our association with them would seem to me quite natural. I hope that answers those questions.
Yes, you have done justice to the questions asked. I still have a few more here. So here, a participant asked, how can Nigerians protect their savings and investments against Naira devaluation and inflation? Another person also asked, what is the future of the stock market with the Naira losing value? I think you have touched base on that already. So I don't think you would need to, or you could just speak briefly on it.
Okay.
And then the last is, what's the future of the stock market with the Naira losing value? I think I've taken that.
Yes.
Okay, so I've taken all of that. So, okay, here, just one more question. It says, what is the best investment option for Nigerians with unavoidable FX liabilities? Then I would take, so when you respond to those questions, I would now take the ones we have here on the chat. And that will be the final questions we have for you today, sir.
Okay, thank you very much, Ngozi. It's a Huawei moment. It's what we call a Huawei moment. Okay, right. So let me look at savings and investment. Savings and investment are crucial elements of the GDP process. If we want to grow GDP, if we want to ramp up economic growth and welfare, it is important that we see growth in savings and investment. However, some of the charts I've showed you the relatively low rate of savings and the high lending rates. So there's this wide spread between your lending rate and your savings rate, right? That conversation can be had another day under certain different circumstances, but that's what we're seeing. So savings is not advisable in a situation of high levels of inflation. But like I have said, the central bank has committed itself to making sure that inflation declines steadily. That is good news. But it doesn't absorb the fact that savings at the moment are not a good haven for parking your money. You get taxed by government doubly, if not triply. You get taxed because inflation is actually a tax. Why is it a tax? The government, let me show you how it's a tax. The government sees the inflation, but the government never says this, but the government borrows money from you at a certain rate. By the time it's paying you back that money, the real value of that money has declined. The difference between the value of the money at the time it borrowed it and the value of the money at the time it's repaying it is the tax. It's an implicit tax. So the government may not worry too much about inflation rates, understandably, except for the optics that look pretty bad. So the government would perhaps just sit on that and say, well, you know what, we're working towards it. But with this CBN governor, I see a commitment to adopting what he calls conventional methods of bring down inflation. That's just our disagreement with him. This is not a conventional situation. And in the art of war, you don't try to use conventional methods to deal with an unconventional enemy. It doesn't work. And let me just make a brief scriptural comment. Why did David defeat Goliath? One of the reasons why David defeated Goliath, one, is the presence of God in his life, but two, and also very important, was the fact that while Goliath was thinking of hand-to-hand combat, That is, he was thinking as if he was an infantry. David was an artillery. And artillery will always trump infantry in any war. Because if you're going to say that you're coming to fight me and I have a gun and a bullet in my hand, for goodness sake, there's no way you're going to win that battle. And that's exactly what I'm saying here, that if you're going to fight this battle to bring inflation down, you cannot use conventional means. And if you do, those who save money will suffer. Investors, it depends. If investors feel that, look, I can come in and go out quickly without any foreign exchange restriction, he'll perhaps come in and go out quickly as what we call FPI, foreign portfolio investment. So he does that, he makes his money, gets out, and within that short period of time, the exchange rate is fairly stable. So he has calculated, okay, this is what I'm likely to make on this transaction. It will compensate me for any foreign exchange losses. So he pulls his money out. But that's not good for the Nigerian system. As a system, I'm not saying it's not good for the investor. I'm just saying that as a system, because it's hot money, the money goes in and comes out, and you can't really plan with it. However, foreign direct investment is money you can plan on, because the money is what is called patient capital. The money comes in and lasts 5 years, 10 years, 15 years, 20 years. That's what I call investment. The FPI, I don't really see it as investment. I see it more as speculation. So I hope I've answered that question. Stock market decline and I think the FX situation. I think I've also answered it here. FX is related to Nigeria's inflation rate. If we don't have the foreign reserves that will help reduce domestic inflation, we're going to have a very torrid time in 2025. One of the things we need to target is not necessarily the symptom, which is inflation. Inflation is a symptom. The real problem is productivity. Are we exporting enough non-oil goods or services that will generate the kind of cash inflows that enable us to strengthen the naira, reduce domestic costs, and reduce domestic inflation? If we answer that question, inflation will take care of itself. It's a symptom, not a cause. The cause of inflation is our relative scarcity of the dollar or any other currency. So we've got to address that problem. And I've recommended how we could go about doing that. So I hope that question has also been answered.
Yes, Mr. Teslim, you've done due diligence to all the questions asked. So now moving on to questions we've received via the chat box. So I have a Mr. Kendi. Beg your pardon, let me just quickly scroll over to where his question is at. Okay, so Mr. Kende here says, hi, I struggle to understand why we're recommending the sale of oil assets or reduction in our JV holdings for immediate service of our debts, when these assets provide us with the regular income for our reserves, debt service, in addition to allowing us to have the upper hand in these JVs. What would be the long-run impact for Nigeria? So maybe you can take that question.
Okay, yeah. Very interesting question. Now, you said it. The JVs have proven very useful to Nigeria. The dividends that come from those JVs have helped us stabilize our fiscal position. That's true. But we've also had challenges when it comes to making our contributions to those JVs. So what we've seen is that the JVs are there, but have we optimized our equity positions? Well, so when there's a call, when there's a cash call, do we meet them? No. So most often what happens is that when there's a cash call, we don't meet it. The international oil companies make up for it and they borrow the money. So what happens therefore is that, okay, if we can't pay them back, we offer them a swap arrangement in terms of oil. So we say that, okay, you know what? We can't pay you the money in dollars because we don't have it and we don't want to put pressure, we don't want to encumber our foreign reserves. So what we will do is that we'll give you oil. And that distorts the whole pricing arrangement, the whole reason why we entered into those JV agreements in the first place. So for me, it's a choice between two evils. Now, if I can sort of reduce, supposing I had a 60% equity in the JVs, for instance, and I said, you know what, let's switch this thing around. Let's do a switcheroo. So the switcheroo is such that you have 60%, so I'm selling 20%. I still hold 40%. I can do cash calls for that 40% conveniently based on my current cash flows. Now, the 20% that I've sold off helps me stabilize my exchange, my foreign reserve position and my exchange rate. Because don't forget, I'm not just worried about the total foreign reserve position. I'm also worried about the net foreign reserve position, which as far back as 2023 was as low as $3.7 billion, according to JP Morgan, right? So, and so you have about $32 billion in foreign reserves. You had about $3.7 billion of that being your free reserves, because all the others were encumbered as a result of swap arrangements or agreements that locked up all those values. There are loans you have taken, and you've used those revenues to securitize the repayment of those loans. So it becomes very difficult, and there's a lack of clarity to be addressed. So I'm not saying, you know, sell everything, sell down our JVs to say 40% where we can meet cash flow. It could even be 30, depending on where we know from those JVs, and use it to soften the severe economic situation we're having currently in terms of domestic inflation. I'm saying that we've got to build up those foreign reserves inflation, because if you increase NPR to 80%, yes, remove the influence of rebasing, I can tell you that you will not see a diminution in the levels of domestic inflation. Yield rates will be high and inflation will be high. And we've seen it in the figures. So if we're going to improve the situation, I still think that certain assets, we can sell them down. When you talked about long-term position, that's a great question. But if you're an economist, most economists who are the Adam Smith School of Thought will tell you that in the long run, we're all dead. Because if you don't take those bitter pills now, in the long run, you wouldn't even be alive to take them. So the best thing for us to do is to pare down our JVs. That's not the only solution. I'm not saying it's one of the ones that are feasible. We pare it down. We still have 40%. It's okay. So the private sector, those guys raise the necessary cash calls, run the system, and we've seen where it works, where we did the switcheroo with the gas sector. And most of our dividends actually are coming from that sector, the Nigerian liquefied natural gas. But because of the same huge amount of equity interest we still have there, and we can't meet certain calls, we're seeing that the trains, I think we're on train 7 now, when we should actually be on between train 10 or 11. We've not been able to move forward. We've been stuck. And that's because of our own national liquidity situation. So it's a question of, I'm hungry, but I have a Chevrolet, I have a Maybach. My priority is survival. So if my priority is survival, let me sell the Maybach, generate the cash flows, rebuild other businesses that will generate future cash flows that will create sustainability for me. That's my answer to that question.
Thank you, Mr. Teslim. So because we're running out of time, I'm going to summarize the 2 questions we have here. The first one is asking us on the impact of NPR on the cost of borrowing for manufacturers. And the second question from a Mr. Taiwo is also stating what will be the impact of investments, given that the government is servicing a debt of about 16.32 trillion, and inflation rates based on the new rebasing is expected to come down. And then, of course, our exposure to FX is not really stable. So what will be the effect of that on investments in the year 2025? In 1 minute, sir, please.
Yeah, I'll try to do that in 1 minute. Okay, right. Let me start with the rebasing. Now, the rebasing doesn't change much. It's just a signaling number. Normally, economies rebase every 5 years. That's the common practice. That's if you use the fixed base methodology of GDP and CPI calculations. Every 5 years, you need to rebase. The last time we did that was in 2014, if I'm not mistaken, or 2013 or 2014, one of those 2 years. So it's been quite a while. So we skipped about 10 years. And now we've decided to do it. And I think it's the right thing to do. We need to rebase. Of course, some countries, especially Francophone West Africa, they use what they call the chain-linked methodology, which means that they don't do the surveys, but they do extrapolation based on last figures. So they rebase annually. So if you go to Francophone countries, their own rebasing is actually chain-linked and typically annually, not 5 years. But the Nigerian method it works. It's quite good. I mean, we actually go out and survey the market and get the prices, and we can get the GDP numbers as close as possible to reality. Now, what is the effect on investment? If I have a correct sense of your size, especially sectorally, it is indicative for me as an investor on where I want to play in your economy. I had a discussion this week with somebody who has talked to some certain partners in the Far East, and they've raised $20 billion for investment in the Nigerian gas sector, the gas and energy sector. That's $20 billion of new investment. And one of the things I was looking at that, look, yes, Nigeria is currently repressed, but in terms of its GDP, less than $200 billion. But the prospects are great. And they see the prospects, and they see the markets where that will be the drivers for that prospect. So investment is going to be greater with a superior GDP number. Because currently Nigeria is around 4th. We are behind, I think we are behind Egypt, South Africa, and Algeria in that order. We are 4th, but we used to be number 1. We were at $510 billion at a point before the adjustments to exchange rate, which were actually needed. We needed to do those adjustments. Like I said, those adjustments were needed. We didn't do them when we should, so we are paying for our delay. And I'm hoping through discussions with people who are close to the arrangement, we won't skip any other rebasing exercise. So I think we're quite good there. Yeah. I hope I've answered that question. I know that I skipped one. I couldn't quite remember that one, but I'm sorry.
We have come to the end of this webinar session, and we would like to extend, on behalf of all the participants, we'd like to extend our heartfelt gratitude to Mr. Teslim Shitabe for this insightful and impactful webinar session. It is also available on our YouTube channel. If you would like to revisit, for those who joined in late, it's available on our YouTube channel. And you can also join or follow our social media platforms for updates on all our activities for the year. Thank you once again for joining this webinar, and do have a good day.
When the night has come and the land is dark and the moon is the only light we'll see, no, I won't be afraid. Oh, I won't be afraid, just as long as you stand